Welcome back, everyone. Today, we are exploring a fundamental concept that every beginner investor encounters when buying mutual funds, exchange-traded funds, ETFs, or unit trusts. Understanding the difference between accumulation, ACC, and distribution, DIS, share classes. As you start building your investment portfolio, you will often notice that the exact same fund is offered in two different versions, accumulation and distribution. While both share classes invest in the exact same underlying assets, companies, and market strategies, they handle the income generated by those assets in completely different ways. Making the right choice between them can significantly impact your tax efficiency, cash flow needs, and long-term wealth compounding. Whether you are investing for retirement, building an income stream, or growing your capital from scratch, mastering the mechanics of ACC versus DIS share classes is an essential step in your financial education. Let us start by examining how distribution, DIS, share classes work. Distribution shares are designed specifically for investors who want or need regular cash flow from their investments. Whenever the underlying companies within the fund pay dividends or generate bond interest, the fund collects that cash and periodically pays it out directly to you, usually on a monthly, quarterly, or semi-annual basis. For retirees or investors living off their portfolio income, this regular cash distribution is incredibly appealing. However, there is a catch. Unless you manually reinvest those payouts, holding cash in your account exposes you to cash drag, and in many tax jurisdictions, those distributed dividends trigger an immediate tax liability in the year they are paid out, even if you choose to park that cash right back into your brokerage account. Moving hand in hand with income distribution is the concept of the dividend reinvestment plan, DRIP. If you like the idea of regular payouts but do not want idle cash sitting in your account, many brokerages and funds offer a DRIP. With a DRIP, your cash dividends are automatically used to purchase additional fractions or shares of the fund on the payment date. While this automates the compounding process and saves you the manual labor of buying more shares yourself, it still does not solve the underlying tax inefficiency. In taxable brokerage accounts, you are legally obligated to report and pay taxes on those dividends in the year they are distributed, meaning the government takes a bite out of your returns before the DRIP even has a chance to reinvest them. This brings us to the core superpower of accumulation, ACC, share classes, automated, tax-efficient compounding. In an accumulation share class, the fund does not pay out any dividends or interest to your cash account. Instead, any income generated by the underlying holdings is automatically retained inside the fund and immediately reinvested by the fund manager to buy more underlying assets. Because the money never touches your personal bank account as a cash payout, it acts as a silent turbocharger for your wealth. Your total number of shares stays the same, but the net asset value, NAV, of each share grows faster as internal dividends are rolled right back into the engine. Another massive advantage of accumulation shares is minimizing tax drag and eliminating friction. By deferring taxable events until the day you actually sell your shares, ACC share classes allow your capital to compound untouched by annual dividend taxes. For long-term investors in growth phases, particularly those based in regions with dividend or income taxes, this can create a staggering difference in portfolio size over a 10 to 20-year horizon. There are no manual reinvestment fees, no fractional share calculation headaches, and no idle cash dragging down your overall performance. Accumulation shares are the ultimate, set it and forget it, vehicle for wealth accumulation. Finally, how do you decide which one is right for you? The choice ultimately comes down to your current life stage and financial goals. If you are in your accumulation years, building a career, and focused purely on growing your net worth for the future, accumulation, ACC, share classes are almost always the superior, more tax-efficient choice. Conversely, if you have reached financial independence, retired, and require a steady, predictable cash flow to cover your living expenses without selling shares. Distribution, DIS, share classes provide the structural income you need. As we wrap up today's breakdown, it is clear that understanding the mechanics of ACC and DIS share classes empowers you to tailor your portfolio precisely to your lifestyle and financial timeline. If you found value in this deep dive and want to stay ahead of the curve on personal finance strategies, fund structures, and wealth-building insights, make sure to hit that subscribe button and ring the notification bell. Drop a comment below letting us know whether you prefer accumulation or distribution funds for your strategy, and give this video a thumbs up if you want to see more content like this. Thank you for watching, and we will see you in the next video.